Okay, so just to recap our journey so far, since the middle of November until early April, I've been giving warning signs in my videos laying out potential scenarios of the market showing a meaningful correction. The rationales I gave to you guys were, number one, the monthly CPI data, which was showing a high level versus the Federal Reserve's target. Number two, the Trump administration's push for a rate cut, which was very conflicting considering the high inflation. And number three, potential implementation of tariffs across all nations, which may lead to an even higher inflation. And number four, strong trend in other key data such as the ISM, the PMI, consumer confidence, which all indicated a strong economic activity, which may solidify the current inflation level. On April 7th, I said that it's time for us to consider buying into the market, laying out a few reasons, including number one, the lowered valuation, which was showing 20 to 25 times price to earnings ratio for big tech companies compared to 30 to 35 times a few months back. Number two, tariff may be a threat to the economy, but political noise generally goes away quite quickly after lingering in the market for some time. And number three, a potential rate cut in the second half of 2025 may boost the valuation even further. Okay, so post-April, I said that while the best time for us to buy may be behind us, whenever the market shows some volatility, it may be a chance for us to buy more into the market in my last market update videos. I walked through some of the key events that are happening in the market, including the big beautiful bill, the tariff, stablecoins, and the Federal Reserve's reactions to the market. Now, with all those news and events behind us, let's look at some key numbers that came out since the last market update. Number one, initial jobless claims for the third week of July was at 217,000, which was lower than 227,000 forecast and 221,000 last month. Number two, 10-year bond auction yield recorded 4.362%, which was a slight uptick versus the 4.421% in the last auction. Number three, month-over-month retail sales change for June showed a 0.6%, which was significantly higher versus 0.1% forecast and minus 0.9% last month. Number four, S&P manufacturing PMI for July was at 49.5, much lower versus 52.7 forecast and 52.9 last month. Number five, lastly, the most important data came out, which was the CPI. Year-on-year CPI for June recorded a 2.7%, which was higher versus 2.6% forecast and much higher versus 2.4% last month. Now, we'll come back to the data later in the video. So the data aside, the market is showing a crazy bull run with the Nasdaq showing over 30% increase from the April lows and S&P showing over 25% increase in the past 3 to 4 months. Now, how can we interpret this? Okay, guys, before we go into any analysis, I'll be honest and I'll say a few things up front. Number one, when I said that it's probably a good time to buy in early April, it was hard to imagine that the market will recover this fast. The market probably gave around 2 weeks of window to buy into the market, and even so, the 90-day pause on the tariff pulled the market up too quickly that a lot of investors were probably hesitant to buy more into the market. Number two, while I projected the political noise and tariff issues to go away quite quickly, it was hard to predict that the market will be hitting all-time highs multiple times this fast. While the market is always unpredictable, this rally was probably one of the strongest bull runs in history if you narrow the time frame to 3 to 4 months. Okay, so having that said, why is the market hitting the all-time highs? I'll try my best to explain the situation by trying to put myself in the market's shoe. Okay, so in order to understand why the market rallied so fast, we need to understand why the market dropped so much until April. I already explained a lot of this in my previous videos, but let's try to recap. Number one, the market was overly optimistic about the new Trump administration. Now, we need to remember one important thing here. Two things which the market hates the most is uncertainties and negative surprises. When the Trump administration first inaugurated, the market movement was clearly expecting a repetition of the first Trump era, which was, number one, low interest rate, and number two, political noise which doesn't fundamentally change the overall performance of companies' financials, and number three, high liquidity. However, when Trump first came into the office, he started tearing apart all the existing diplomatic relationships and started resetting everything to have everything center around the US. The market didn't know what to expect from Trump and started going downhill. Number two, the CPI was still at a high level. Higher CPI means that the interest rate needs to be kept higher for longer to cool down the price level. Higher interest rate means that the US may have to increase their debt level to finance the interest, which would potentially lead to a higher deficit. Number three, key data such as PMI, ISM, and unemployment was still indicating a strong economy, which means that a rate cut is not imminent anytime soon. As I said all the time, one thing you need to clearly keep in mind is that the interest rate directly impacts valuation of assets. If the interest rate is high, the denominator, which discounts the future cash flow yielded from an asset, is high, which leads to a lower valuation of companies' valuation and vice versa. Therefore, the key indicators which were coming out were pointing towards a high interest rate environment prolonging for a long period of time as well. Okay, so those were the key reasons why the market dropped so much. So let's now try to look at what happened for each of the points during the past few months. Number one, on the Trump administration, the market was reacting super negatively on Trump because from the market's perspective, he was not the guy the market used to know. But the 90-day pause on the tariff plans changed everything. I repeat, it changed everything. Now, imagine a situation where you're working at a job and your boss comes to you. This boss used to be a very nice guy who doesn't give you much work and pays you a lot. The only thing the boss wants from you is to give him support whenever he needs it in the office. So regardless of whether you like the boss or not, you think that as long as you keep this job, you'll be fine. But one morning, the boss comes to you and says, "Hey, I need you to finish this work by tomorrow morning." You never saw the boss giving such tight timeline, so you panic. While you're panicking, your boss comes to you again after lunch and says, "Hey, do this work as well by tomorrow morning. If you don't get it done, I'm going to cut your pay." You panic even more because you never saw your boss acting that way. The work is impossible to be completed by the next morning, so you kind of give up and decide to accept the pay cut. Then, in the afternoon, the boss comes to you again and says, "Hey, you need to do even more work. Please draft more materials and give it to me by tomorrow morning." At this point, you just kind of give up on everything and almost decide to quit your job. But right before you head back home after giving up and without completing any work, the boss comes to you again and says, "Hey, sorry about all that. Actually, I don't think those work make any sense. Let's rediscuss after 90 days on what to do." And he smiles. At this point, what do you think you're thinking? You're probably thinking, number one, wow, I don't need to worry about quitting my job. Nothing changed, and I'll just come back to work tomorrow morning and continue doing what I was doing. And number two, wow, this boss was crazy today, but after all, he actually didn't give me any job today. So I guess he's the same guy I used to know. You'll probably go to the other people in the office and tell them about the story as well. People might think that the boss can have a few crazy days, but after all, won't make you work crazily. Also, if the boss does the same thing to another employee, you'll probably go to him or her and tell them about your story and tell them not to worry. The reason the market was so shocked with Trump's action was because the market thought Trump is a market-friendly guy and cared about where the market is heading. But his actions were nowhere close to the Trump the market used to know. So the market was extremely confused. But with the 90-day pause, the market regained the trust in Trump that if the market shows some tantrum, Trump will revoke whatever he said and will try to bring the market up again. Now, this is beneficial for both market and Trump. The market has now gained the confidence that Trump will revoke whatever plans he puts out whenever the market drops. So investors don't need to worry about the market going down because of Trump anymore. From Trump's perspective, he now gained the market's trust, and given the market thinks he'll revoke whatever he said if the market goes down, he now doesn't have to worry about the market going down because of what he does. So it's a very weird circular situation where the market continues to go up, ignoring whatever Trump does, because the market knows that Trump will not let the market go down, And because of that, Trump can just do whatever he wants because the market won't go down because of him. While tariff negotiations are still ongoing, if we look at the latest tariff announcements, there were some percentage cuts for some countries like Japan and Indonesia, but there were also some countries which the rates went even higher or the same as before. However, the market is still not reacting negatively to any tariff news. Okay, so that's how the first issue is addressed. Okay, so the second point on CPI. A lot of you may remember the 3 potential scenarios I suggested in my previous market update video after Trump administration inaugurated. The scenarios were, number 1, ignore inflation scenario, number 2, fake blaming the Fed scenario, and number 3, fake the tariff scenario. In my last market update videos, I also noted that Trump is now officially caring less about inflation and is going full force with addressing the twin deficits to increase the country's GDP. I also noted that Trump is trying to use, number 1, tariff to decrease trade deficits, number 2, the big beautiful bill to protect consumer spending power and hedge the additional inflation which may come from the tariff, and number 3, stablecoins to increase the demand for the US Treasuries to roll over the country's debt. Now, having that said, we need to focus on the first point, which is Trump caring less about the inflation. Now, the market was super negative because the market believed that Trump will inevitably have to address the inflation to protect the position of the dollar in an international market. If inflation gets out of control, people and the market's faith in the dollar may collapse, which may be catastrophic for the US. But Trump decided to go the other route by caring less about the inflation and pressuring the Fed to lower the rates while hedging the consequences through the big beautiful bill and stablecoins. Now, from this aspect, the market has to act fast because, number 1, if the inflation is going to prolong in the market, purchasing assets, including stocks, is a hedge to protect your position. And number 2, if the interest rate is potentially going down, it'll directly increase the valuation of companies, which means that the faster they buy, the better, prior to the lower interest rate being fully priced into the valuation of companies. And number 3, the only concern was the weakening economic activity and refinancing the public debt. But if those are also hedged through the big beautiful bill and stablecoins, there really is nothing to worry about. Okay, so this is how the second point is also addressed. Number 3. Okay, so with the 2 issues addressed, the third issue is also naturally addressed. As long as the inflation is not a concern anymore, strong economic indicators is actually a plus to the market. If the interest rate is expected to go down, even despite a vulnerable inflation level, everyone needs to rush over to buy more stocks as fast as possible. Basically, an inflation coupled with a low interest rate will continue to drive the valuation of companies up. And while nobody knows when the valuation will peak out, until that time comes, the market is believing that there's nothing to worry about. Okay, so going back to the data, if we apply the market sentiment to the data, this is what the market has to be believing to show this kind of bull run. Basically, the data is saying that the job market is still stable, which is good. The only concern was that the interest rate may go higher with the stable job market, but that concern is not valid anymore. Bond auction is showing some uptick in the rates due to some nations turning away from the US bonds due to tariff conflicts, but lower interest rate and stablecoins will address any concerns which stems from this issue. Retail sales are strong, which may lead to a high inflation, but that's okay because interest rate is not going up. PMI is weaker than we thought, but this is good because this justifies an interest rate cut. CPI is higher than we thought, but that's okay because no one cares. Now, this is what the market is probably thinking, and what the market has to be thinking to justify the recent bull run. There's really no other way to explain it. Okay guys, so I try to put myself in the market's shoe and give you guys the market's narrative on how the market is thinking about the current situation and why the strong rally is happening. Now, I personally think that while the market is going frenzy with a bull run, I do believe that the valuation of companies will peak out at some point and the market may show some mild pullbacks, which I think there may be opportunities for us to buy more into the market. While I don't think there will be a significant market crash anytime soon unless we encounter something really unexpected, I do believe that there will continue to be a fight between the market's optimistic sentiment and the fundamental valuation of companies. I believe a further visibility on the rate cut happening in the second half of the year will be crucial, and until then, while we need to buy into the market whenever there's an opportunity, we still do need to monitor the market with a bit of doubt on where the valuation level is headed. Thank you, and I'll be back with more videos very soon.